Assalamu alaikum viewers. I am Dr. Safdar Husain Tahir, Associate Professor, Lalpur Business School, Government College, University, Faisalabad. I did postdoc from UWA Business School, the University of Western Australia. In the previous lectures, we have already built the structure of a firm where some assets, liabilities, and owner equities are debited and credited. By crediting and debiting these entries, we have already prepared the balance sheet. In this lectures, we deal with some additional entries of the income statement and then incorporate these entries in income statement. Let me explain you and show you of the previous lectures what we have already did that. These are the different 10 transactions, and we have debited and credited these transactions in the previous lectures, and from these transactions we have already prepared the balance sheet. So far there are assets, liabilities, and owner equities, and there is no income statement, revenue, and expenses. So in the second phase, in this lecture, we are going to discuss the additional entries of operation and income. This is the 11th entry that December 12, we sell inventory costing 2 lakh for Pak rupees 4 lakh in cash. How can we deal in it? So this is the 11th entry. So we sell the inventory for the cash. So the cash debited, cash increase 4 lakh. So the cash debited. And then you can say the cost of goods sold. There is a new account because this is the composite entry. When you sell the inventory, there's certainly a cost of goods sold. That account will be generated. So the cash increase of 4 lakh. So we debit it, and cost of goods sold of 2 lakh. Then sales revenue is a 4 lakh, that is a credited, and inventory which is in decreasing, which is an asset and decreasing, that is credited. So we journalize this transaction into a composite entry. Again, in the 12th December, we purchase inventory on cash. So the account on cash and credit. We purchase the inventory 2 lakh and 50,000 on cash and credit. So the inventory increase 2 lakh 50,000, and cash we paid decrease 1 lakh and 50,000, and account payable increase 1 lakh. So that is why we debit and credit of this entry in this way. Then in December 16, we paid shop rent, so prepaid rent. This is the prepaid rent, December 16. The month started from the 16th December. So this is the prepaid rent, still not expired. This is our asset, and we paid a cash decrease, and this is our asset also. Asset decrease, credited; asset increase, debited. Again, on 18 December, paid the advertisement expense. So we paid the advertisement expense. Advertisement expense at 20,000 is debited because this is the expense. Expense always debited, and cash which is decreasing, and that is 20,000. This is a credited. Again, on 20th 20th December paid the salaries expense and cash. We paid the salaries. So the salaries expense are generated, and that is 50,000, and the cash which is decreasing, that is credited. Again, on 26th of December, the owner drawing withdrew for personal use 30,000. The owner drawing 30,000, that is debited, and the cash, that is credited. So the total of this entry is 9,90,000 debit and 9,90,000 credit. So we additional entries are debited and credited in journalization. So this is the journal. So we prepared the general journal. When we incorporate the previous 10 entries with this 5 entries, so it becomes this one. You can say this is the previous journalization, and this is the new accounts, income related accounts. So the total is 65 lakh. Total debit is 65 lakh is equal to total credit of 65 lakh. In this way, we journalize the additional entries, and I hope you understand this process of journalization. Watch next lectures for the upcoming transactions process of these transactions. Thank you so much.